All right, it has been a little while since I posted a video, about a week or so, and I've been posting them at a slower interval, and that's because I did have a business loan that was called in, which is fine. I'm still good, but it locked up some of my liquidity, so I did pay back the loan and got another smaller one, uh, which it's eaten a little bit in my equity. So I haven't been posting as much trades. Still trading, but doing a lot more predictable stuff that I've already explained here. So I'm not doing the high frequency trading and the 10 calls and the 14 puts and stuff like that. But I'll get back into it eventually, doing stuff like that, especially when the market comes back in a little more. If you look at this right here, we had a pullback, immediate pullback at about 4,600. This is an anticipatory pullback. People started selling off as they didn't want to lose the they didn't want to miss the sell off, so they started a little early. But this is essentially a 4,600 level pullback. And if we go all the way back to our all time highs, you have a pullback here, a pullback here, a pullback here, and then the all time high was back here. So this pullback created newer lows, while these pullbacks, I believe, look like they're trending to make higher highs. So I predicted by the end of this year that we would break this all time high of 4,800. But then I predicted that right about here. And then we had this pullback, which kind of makes me look kind of dumb. But then quickly we returned on this incredible run up that now it looks possible again, because it took us how long from it took us from July to August for this downturn. So that was a pretty good downturn, 3 months, and then we just made it all up inside of 1 month. And so we're back up into the uptrend, and maybe we'll make all time highs again. We'll see. We'll see. But this reminds me to take profits. Okay, this reminds me to take profits. Always take profits when you can. So here's what I'm looking at. I got Intel shares right here, 100 Intel shares. I'm long a call, 36 call right here. And I bought it for 300, 320 right here. I sold two cover calls that are currently in the money because it's trading at $44, and they're $400 each in the money. Now that's fine with my shares. Those will be called away, no big deal. This right here, I'm gonna lose about a month of premium. So I sold it for 300. If it triggers 2 weeks from now, then I'm gonna lose the time premium from January 19th to December 15th. Okay. Even if this was a 36 call to a 36 call, just the 1 month difference would be worth would be worth some money. So what I'm gonna do is I'm gonna take some profits, and the way you take profits is, see this spread right here, 36 to 40. That's $400 difference right there, plus the time difference. So I could take $450 profit off this, and then then I'll be in a better position if uh, Intel dies. Because if Intel dies, these calls are gonna expire worthless, but this call right here may expire worthless as well, which I'm gonna regret not taking profits if I do that. So if I roll this long call, I wanna leave these calls alone. They're 2 weeks out. It's fine. They may trigger, but what I want to do is I want to create the money on my long call. So those are currently trading at 960. So I got $600 locked up in these in profit. What did I do? Oh, I hit analyze. Okay, let's do this. Let's roll it. Let's see what options are available to me. So keep December 15th in your head. Create a rolling order for that long call. So I'm going to sell out of my current one, the 36 for January 19th. And I'm going to anticipate that this is going to trigger December 15th. So I want something after December 15th, but not on December 15th. Because I want to make sure that it triggers before I exercise it. So let me hit that. So just by changing the date of this, which is 3 weeks, it gave me 25 bucks. Not a big deal, but you know what? I paid 300 and that 300 could dissipate quick. And it's currently worth 900. So why would I let it ride? So then I take this 36 and I move it closer to the 40. So 39.50. Boom. Oh, it's not traded. Okay, let's do 39. So that locks in $325. $25 from the calendar, from the time, and $295 in profits by moving the strike. Now, see, I lose. The difference between strike 36 and 39 is $300. I'm only sacrificing $5 to exercise it or to roll it early. Okay. Oh, it just went down again. Damn it. So I just sacrificed $200. So I just sacrificed $7 to roll it early. But that $7 in lost profits will ensure that I pocket the money now and I don't wait. I can still pocket the difference between 40 and 39, which is $100, which is $1 a share. I'm still going to pocket that when it's still profitable. I'm just taking back the money that it cost me for the long call. And so now this trade is free. I have all my money back. Anything else is pure profit. So that's how you take profits on a poor man's covered call when you know it's going to trigger.